look at exercise 10. We're going to actually look at the journal entries to account for note receivable. So it says on June 6th, Lakeland Bank and Trust Company lent $110,000 to Samantha Michael on a 90-day 9% note. So we're going to first journalize the entry for lending them the money on June 6th. So June 6th, we lent them the money. So we're going to record the note receivable. Remember, notes receivable are an asset. They are just evidence. They're like a receivable, but they're longer term, and they have to sign that promissory note. And this was for, let's see, for Samantha Michael, and we lent them $110,000, and we would reduce our cash. All right. Then they want us to journalize the collection of the principal and interest at maturity and specify the date. So this was a 90-day note. So it was issued on June 6th. So that means that 90 days from June 6th, all the principal and outstanding interest are due. So let's look at what the maturity date is going to be on this note. So we issued it on June 6th. So we have only a portion of the days left in June. So in June, June has 30 days. So we have 30, and it didn't start until after June 6th. So we had 24 days in June. July would be 30 days. August, 31 days. And September has 30. July has 31 days, not 30. Let's switch that. All right. But we have to total up how many days we already have in here and total up. So September has 30, but let's count. So here we have in July, that makes up a total of 55 days. And then the end of August, we have 86. So to get to 90, we only need 4 more days. So September 4th is our maturity date. So September 4 is the maturity date. Okay, now let's look at on maturity. We're going to collect not only this principal here, so we know we're going to collect cash. Cash is going to be our debit. We're going to collect the outstanding principal, plus we're going to collect the interest. All right, but we have to calculate what the interest is. So down here, we have principal of $110,000. And our interest rate was 9%, so we're going to multiply that by 9%. And we only had this note for 90 days out of the year. So we're going to multiply it by 90 divided by 360. And that's going to give us our interest of $2,475. So we're going to take, we took the 110,000 times the 6%, I'm sorry, the 9%, times 90 days over 360. And that gave us the $2,475 in interest. So that's how much cash we're going to collect when this thing matures. Okay, so we're going to collect the 110 plus the 2475. We're going to collect all of that. And when we collect this, that means the note is no longer in something that's due to us. So we need to get that note receivable off of our books. So we're going to credit note receivable from Miss Michael for the 110,000. And for the revenue we've earned on the interest, we're going to do interest. Revenue is going to be a credit, and that's revenue that we're recording. Okay? So that's how we would journalize the lending, issuing the note, and the maturity. All right? If you have any questions, post them to the discussion board or send me an email.